Hello friends, welcome to Learn Easy. Today in this session we will discuss asymmetric information, hidden actions, moral hazard, adverse selection and lemon problem. Asymmetric information refers to a state where market players have different levels of information about each other's valuation of the markets. Asymmetric information describes a situation where one side of the exchange, the buyers or the sellers, knows more about the product than the other. Generally, we might expect the sellers of goods to know more about them than buyers. In reality, market players tend not to know everything about each other. That is, information in the market is asymmetrically distributed. Information is valuable, and better informed market players can take advantage of their superior information to achieve better outcomes than less informed players. A seller selling his second-hand car will have more information about the car's issue, which gives him an advantage in the transaction. This can happen when a seller who knows better sells his goods or services to the buyer. Usually, information asymmetry exists in all natures of transactions. Asymmetric information can also arise when agents' actions are not visible to all parties. For example, a customer may hire a mechanic to fix his car, but he does not observe the actions the mechanic actually takes. The mechanic might say he replaced a part when, in fact, he did not. The insured party may not provide all the past health issues in insurance policies to obtain a less costly insurance service. This will be a disadvantage for the insurance company. Insurers cannot monitor the actions and private information of the insured. For example, in car insurance, the insurer does not know how carefully a driver actually drives. In health insurance, the insurer might not know about pre-existing conditions and lifestyle of the insured. Because of the information asymmetry, insurers have to charge a price that is an average of the costs of their insured. The price is often too high for the most desirable consumers, causing them to not purchasing insurance. Asymmetric information can also be viewed as the specialization and division of knowledge as applied to an economic trade. For example, doctors typically know more about medical issues and practices than the patients. After all, physicians have extensive medical school education backgrounds that their patients generally don't have. Advantage and disadvantage of asymmetric information. Along with disadvantages, asymmetric information has advantages too. The main advantage is, as workers strive to become increasingly specialized in their chosen fields, they become more productive and consequently can provide greater value to workers in other fields. For example, a stockbroker's knowledge is valuable to a non-investment professional, such as farmer, who may be interested in confidently investing in stocks to prepare for retirement. In their respective trades, the farmer and the stockbroker hold superior knowledge over the other, but both benefit from each other's speciality and division of labor. Disadvantages: in some circumstances, asymmetric information may have nearly fraudulent consequences, such as adverse selection, which is a phenomenon when an insurance company encounters the probability of extreme loss due to a risk that was not divulged at the time of a policy sale. For solution, life insurance providers conduct detailed health screenings and then charge different premiums to customers based on their honestly disclosed risk profiles. Hidden action problems arise in many economic relationships wherever there is an action that benefits the principal but is costly or difficult for the agent, and the action cannot be specified in a contract because information about it is either asymmetric or unverifiable. The problem of hidden actions occurs when some action taken by one party to an exchange is not known or cannot be verified by the other. For example, the employer cannot know or cannot verify how hard the worker they have employed is actually working. The term moral hazard originated in the insurance industry to express the problem that insurers face. The person with home insurance may take less care to avoid fires or other damages to their home, thereby increasing the risk above what it would be taken if insurance would not be. Hidden action now refers to any situation in which one party to an interaction is deciding on an action that affects the profits or well-being of the other. The affected party cannot control this by means of a contract, often because the affected party does not have adequate information on the action. A consequence of hidden action is moral hazard. Moral hazard occurs when a person takes greater risk or behaves less carefully. Because they are shielded from the consequences of their action. The classic example: a person with comprehensive car insurance drives more recklessly because he does not bear the full cost of an accident. An investment banker may gain a bonus for making high profits. This encourages the banker to test risky investments. Moral hazard occurs in situations in which an economic agent chooses how much risk to take, while the potential negative consequences of these risky choices are, full or part, borne by another party. If he fails and loses a huge amount, the losses are absorbed by the bank or taxpayers, not by the individual banker. The protection from risk is expected to induce the agent to change behavior, taking on excessive risk or exerting less effort to limit damages, thereby leading to suboptimal economic outcomes. The protection from risk is expected to induce the agent to change behavior, taking on excessive risk or exerting less effort to limit damages, thereby leading to suboptimal economic outcome. An insurance contract that covers the cost of damage from an automobile collision might cause the holder of the contract to drive in a less cautious manner, increasing the risk of accident. If the actions of the contract holder could be monitored, the problem would go away, as the contract could be written to take behavior into account and either prohibit or charge a price based on the nature of the actions the contract holder engaged in. It is the hidden action aspect of these contracts that gives rise to moral hazard. Adverse selection occurs when the more desirable attributes of a market withdraw due to asymmetric information. This could be better quality products, better quality consumers, or better quality sellers. The result is that consumers and producers may not make transactions that are socially beneficial, transactions that would yield positive producer and consumer surplus. Adverse selection is the market failure associated with asymmetric information, the ability of the more informed agents to exploit their advantage. Insurance markets are a classic example of market failures from information asymmetries. Information asymmetries exist in insurance markets since there is both hidden actions and hidden characteristics. Insurance markets are a classic example of market failures from information asymmetries. Information asymmetries exist in insurance markets since there is both hidden actions and hidden characteristics. Adverse selection differs from moral hazard in that it occurs before a transaction, while moral hazard arises after an agreement is made, both involving information imbalances. In the case of insurance, avoiding adverse selections requires identifying groups of people more at risk than the general population and charging them more money. The general consequences of adverse selection is that it increases costs since consumers lack information held by sellers or producers, creating an asymmetry in the market. This can also lower consumption as buyers may be wary of quality of the products that are offered for sale. Adverse selection arises from asymmetric information where one party, often sellers, holds more information than others, thus leading to market inefficiencies. This happens in selling of used car where more information is there with seller of used car. Also, adverse selection arises from asymmetric information where buyer holds more information than others, thus leading to market inefficiencies. This phenomenon is especially evident in insurance markets, where applicants may conceal critical information that highlights their higher risk, thereby causing financial strain to insurers. Effective strategies to counter adverse selection include gathering more information and implementing robust evaluation measures. To level the informative playing field between buyers and sellers and promote a fair and transparent transaction environment. Lemon problem. Since buyers cannot distinguish between high quality peach and low quality lemon cars, they offer only the average value. This prompts sellers of high quality cars to leave the market, resulting in a market filled with lemons. Warranties and guarantees offered by sellers can also help, allowing consumers to use a product risk-free for a certain period to see if it has flaws or quality issues and to return them without consequence if any arise. Laws and regulations can also help, such as lemon laws in the used car industry. Federal regulatory authorities such as Food and Drug Administration (FDA) also help ensure that products are safe and effective for consumers. Asymmetric information causes two main issues: adverse selection, hidden information attributes before a deal, and moral hazard, hidden actions after a deal. The lemon problem is a classic problem where adverse selection causes high quality goods to be driven out of the market by low quality ones, that is lemons, as buyers only pay average prices. That's all for today. Thank you.